For this session, we have Chair Professor B. Kamaiah, former Professor, University of Hyderabad. Sir also has been the former President of TILES, and his core research areas are monetary and financial economics, international finance, and applied time series analysis. We welcome you, sir. Kindly please come on the dais. Professor B. Kamaiah. The speakers, we have two speakers for this session. First, we have Dr. Soumya Kanti Ghosh. Sir is Group Chief Economic Advisor, State Bank of India, Mumbai. He has been associated with other corporate institutions as well as many working groups formed by the Government of India, and has been involved in the pioneering work to capture the payroll data in India and other significant contributions. We welcome you, sir. Please come on, guys. The second speaker for the session, Dr. Tirthankar Patnaik, Chief Economist, National Stock Exchange, Mumbai. He has more than 20 years of experience working in the area of macroeconomics, portfolio strategy, quantitative finance, and consumer banking analytics, and holds a PhD from IJDR, Mumbai. We welcome you, sir. Kindly join us on stage. Local organizers would like to felicitate the chair and the speakers, and then we begin the session. So they would like to speak, sir. I invite Shukravan Das, sir, to felicitate the chair and the speaker.
Yes. And it will also publish on YouTube or from our pictures, videos, everything.
Thank you, sir.
Nice.
Over to you, Kamaiah.
A very good afternoon, sorry, good morning to all of you. I'm highly delighted to be here this morning in the context of the Indian Econometric Society. As part of this, today we have the panel discussion on the emerging issues in financial markets. This is with a special reference to the Indian context. We have two eminent speakers, Dr. Soumya Kanti Ghosh, Chief Economic Advisor, State Bank of India, and we also have Dr. Patnaik from SEBI. All through we have been discussing the academic issues, but today we get on to the ground and we'll have a peep into what is happening in the banking sector and also what is happening in the Indian stock market. Well, if we go on talking about the financial sector, there is so much to discuss. But in view of the limited time, I would only offer a few remarks. In the past 1 decade, there have been rapid changes in the financial sector. And along with these changes, there are also certain challenges and certain issues. Now, what those issues are and how to tackle those issues, I think we learned from the distinguished panel speakers. In my view, the financial sector has a few very challenging issues. The first one is digitization, which has been happening on a rapid pace. And in the process, we also have the third-party payments. And we also have certain regulations to control these things. So how should the digitization process be in the best interests of the growth of financial markets? So that could be one issue. The second issue refers to the data analytics. So to what extent data analytics and the fintech programs would aid in appropriate decision-making process in the financial sector. Then other equally important issues are cyber security, then how to manage the financial risk. And yet another important issue which is really emerging is the cryptocurrency. Once the cryptocurrency gains prominence, what are the additional problems that the financial markets in particular and the economy in general may be facing? So these are some of the issues to my mind. We will have to deliberate and then take appropriate solutions. So I wouldn't like to come on the way between yourself and the panel speakers. First I would like to invite Dr. Soumya Kanti Ghosh to share his thoughts on the emerging issues. Thank you.
Good morning everyone, and it's always a pleasure to come here and speak to all of you, and it's so nice to meet our professors and my professor over here, Professor Krishna said. I think it has been, I still remember those days, decades back, when you used to get up at 9 and attend the classes. It was so fascinating. And still, I think whatever we have learned in the course of those days in our universities, Delhi school, I think still I cherish that, and I will cherish that all through our life. But having said that, I think what I will do today is that I will speak to you about some of the emerging issues in the financial markets, what has been currently happening, and what I will mostly speak about today, I think if I have time I will digress a little bit, is on the changing contours of the monetary policy in India post-pandemic. So there has been some changes which has happened in the conduct of the monetary policy post-pandemic. I think all of you must be familiar that India has moved over to an inflation targeting regime from 2016, and since then I think but after that the pandemic happened, the pandemic had gone, we had an era of unprecedented global inflation. Indian inflation also had peaked, it's now coming down. So in the midst of that, I think there have been several aspects of the policy which possibly is changing and which could actually be one of the issues in the financial markets in the future, and this could be also an areas of future research for researchers. Some of these areas we are also working on, but I will highlight some of the most pertinent topics today. This is basically the 7 areas of Indian monetary policy. Just for a digress on a little review, I think 7 is a very lucky number in the Indian context. There are 7 wonders. There are 7 aspects when an individual gets into marriage. So there are many things of 7. So in India there have been 7 areas of monetary policy. If we start from 35, before independence, the exchange rate was the nominal anchor. Then 49 to 69, the monetary policy was synced with the 5-year plans. So basically credit was available at that point of time. If you remember, the bank rate, reserve requirements were most predominant. 69 to 85 was an era of credit planning, where the bank rate to address the implications of money supply for price stability. 85 to 90 was monetary targeting. So again, in this case, expansion, reserve money, operating target, and broad money as intermediate target. 1988 to 2015, we had the multiple indicators approach. I think in changing policy rates, reverse repo rate were the signaling device for changing the price of liquidity and using it as a signaling device to indicate the regime shift, if any, of the Reserve Bank of India. 13 to 16, there was a precondition set for inflation targeting because it was thought that the multiple indicator approach may not be too much focused because there are many set of indicators, so there is no clearly defined nominal anchor for monetary policy. In 2016, the RBI introduced the flexible interest inflation targeting. The statement goes like that: the primary is according to the object of price stability, while simultaneously focusing on growth when inflation is under control. So it's basically, that's why it is called flexible inflation targeting, because you are given a band of 2 to 6% and you need to work around that band but move towards the median target over a point of time. Now, what has been the shift which I discussed today and in the pre-pandemic and post-pandemic? As you know that the primary object of policy is price stability and keeping in mind the objectives of growth. Now, there are 4 contours where we have seen a paradigm shift, and there are actually a lot of things happening in the financial markets. I'll go take you through some of them. The first is the policy transmission through rates and liquidity. First, policy transmission is now happening because of some changes which has been done on the operating part. The second part, and there has been a lot of literature on this forward guidance for monetary policy communication. If any of you have been following the literature on this monetary policy, I think gone are the days of the locus and the 80s. After the 90s, I think what has emerged, and most precisely after the financial crisis, that the monetary policy and the central banks use the policy communication as the forward guidance. And it has been worked in India very well post the pandemic. Then there has been a synchronized policy coordination with the fiscal policy. I think in the Indian context, this has been the problem. Monetary and fiscal policy coordination, if you look into longer periods of time, has been absent. Fiscal policy has been mostly pro-cyclical, and monetary policy has been often left with the enviable task of addressing the inflation controls. And the fourth important point is the financial stability. And all these points, the central bank has actually opened up new vistas of new shifts in terms of the monetary policy print. I will discuss each of them, and each of these distinct imprints has future implications for financial markets, and this could be areas for future research. Very quickly, this is the price stability is the primary object of central bank monetary policy if you go around the world. The US Fed has actually given 2 co-equals for monetary policy: the maximum employment and stable prices. The European Central Bank is to maintain price stability, the Bank of England is to maintain price stability, and also there is a word on growth and employment. Bank of Japan decides and implements monetary policy with the aim of maintaining price stability. So basically, price stability is the overriding objective of any central bank's monetary policy, but there is also these issues of employment, growth has been liberally set into the policies for some of the central banks, of which RBI, the last slide which I showed you is while maintaining equal emphasis on growth. And now let me start with each of the 4 issues which we have discussed in my first presentation. The first issue where there has been a profound change post-pandemic is the transmission, monetary transmission. Now, transmission, as you know, can happen through rates, through liquidity, and also I will talk about other trends. The first thing which I will talk about is that, as you know, the monetary policy always works with long and variable lags. So any action taken today works to the system in 4 to 6 quarters. Now what happened is that before the policy and after the policy, the Reserve Bank of India has moved over to a system of external benchmarking. So external benchmarking means that if, for example, the signaling device of the RBI is say currently is at 6.5%, what it has been proposed is that the bank should also, if it changes, the rates of the bank should also change in the equal proportion. So basically, what the banks do today is that, for example, if the lending rate of the banks for the retail sector are to be proposed, it is linked to say a repo rate plus some term premium. So at the end of the day, if the repo rate changes by say 25 basis points or 50 basis points, immediately the rate of interest will actually change. This is basically, and this has been an innovation for the banking sector post the pandemic, and I will show you in the subsequent channel is that while for some of these sectors like MSME and retail, the banks have external benchmark linked loans, meaning that if the repo rate changes by say 25 basis points, which means 6.5 to 6.25, your rate and our rate MSME retail will change by the same percentage. What it has done, but there are some other things which I mentioned, but what it has done is that in the current tightening cycle, as you know, the RBI is still in a tightening cycle since May 2022. The previous easing cycle was in August 2008 to April 22. Transmission has been almost complete for fresh deposits and EBLL linked loans, which is MSME and retail. There are two graphs over here, and this has been also been one of the points which have been emphasized by the central bank. If you look at the easing phase from August 2018 to April 22, and these red are actually the percentage change which was transmitted to the banking system after this, and this green bar shows the basis point change in the rates of that particular instrument. So you can see that the repo rate which has changed by 250 basis points in the April 2008 to April 22, the outstanding rate on outstanding deposits which was changed by 169 basis points for an increase of 250 basis points. The transmission was 67.6% on that one. On the MCLR is another rate. I will not get into the details of that. This is another lending rate which the banks decide. There was a 135 basis points, 212, 163. Now look into the corresponding tightening phase which is happening today. If you look into the external benchmark lending rate, the transmission is complete, is 100%. On the fresh deposits, for 250 basis points, the deposit rates have increased by 246 basis points on fresh deposits. On outstanding deposits also this has gone up, the number is higher. On fresh rupee loans also you can see, and the important thing is that it has been asymmetric. The rates actually have increased more for the deposits than for the lending rates. If you look into the fresh rupee loans in the easing phase, it was 84.8, and the tightening phase it is 72.4. And in outstanding rupee loans, the percentage is 65 and 45%, indicating that we are perhaps in a regime, and that's why if any of you follow the monetary policy announcements and the reports which the Reserve Bank of India published, we'll always find that there is a statement that the governor also says that the transmission is still not complete. Because if you look into this data, we'll find that the deposit rates possibly have adjusted more than the bank lending rates, because bank lending, what is happening is that there are two components. One is the EBLR rates, other is the MCLR rate, which is basically a hybrid of term premium cost of the banks, which has not fully adjusted. So if you take this as an understanding, the transmission has been incomplete. Now next, go to the next slide. This is again an interesting point, is that what I said in the earlier slide, the rate transmission to short-term papers for working capital loans has been not commensurate. For example, short-term capital loans of less than 1 year now quoting at lower than the treasury bill rates. So this indicates that basically what is happening is that if you look at the bond spread also, the 3-year AAA bond spread, which was 171 basis points in May 20, is now moved to only 60 basis points, suggesting that the 3-year bonds are not priced with adequate risk premium. So there is a question which we pose. This could be an area of people to research, whether it's a better bargaining power of the corporates or it's a risk pricing which is not getting properly priced. Because today you will find that there are many working capital loans less than 1 year where there is an intense competition across banks, whereby the pricing is possibly not reflecting what it should do in an ideal circumstance. So on the one hand we have full transmission for the retail and the MSME, on the other hand there is a better bargaining power and possibly some risk pricing which is aggressive. So this is one aspect of the transmission which has happened post-pandemic. Next is the other important thing, and this is basically going to change the contours of the liquidity. As you know that the Reserve Bank also modulates the signaling in terms of a liquidity channel, and I think this has been mentioned also in the MPC minutes by Professor Goel recently of this liquidity channel. Is policy transmission is now, liquidity channel is now more asymmetric. This is basically, and description of a graph of liquidity management. Positive numbers means there is a positive impact of liquidity, and negative numbers means there is a withdrawal of liquidity. As you know, that currency in circulation is a leakage. The OMO purchases, if the OMO is purchased, that's an injection. OMO is sold off, liquidity is what? There is cash reserve ratio, there is net and sound of foreign currency, and there is also LAF injection. LAF is basically the liquidity adjustment facility, whereby the RBI injects rupee and take out rupee through several instruments like variable reverse rate repo. Now, what has been recently happening is that the government of India is now resorting to novel mechanism like just in time to efficiently channel resources towards funding centrally sponsored schemes through RBI liquid channel. So this actually what it does is that whenever the government spends, the government cash balances actually comes back into the system through the banks, and that has a positive impact on liquidity. But currently what is happening is that these government cash balances are remaining outside the banking system because the government is trying to put in place a system of efficient resource transfer, whereby if the states are spend 75% of the amount which has been disbursed earlier, then only money is given to the banks. This is on an experimental basis in states like Rajasthan. But what it is making is that, so the money actually goes directly from the RBI and not from the banks. Earlier this money was with the banks' accounts, possibly which we call the CASA account, the current account and the savings. From there the money needs to go. Now this money is bypassing the banking intermediation channels, and this is possibly aggravating the systemic liquidity further. There are some numbers over here. You can see that repo outstanding and the government cash balances. You can see that the higher government cash balances mean that the government is not spending. On 8th February, this amount was 4 trillion, which was lying with the RBI. This number is almost unchanged at 3.8 trillion since then. The average in the current fiscal year has been around 2.4 trillion. So we are having in a situation when if we include the government cash balances, which is called the core liquidity, the system is in a liquidity surplus. But if you take the RBI repo transaction, reverse repo transactions, that is actually in a deficit. And this is basically happening because of this mechanism. And what it is doing is that you can see that the yield curve, basically the different rates which we are saying, if you look at the 30-year yield rate, the 10-year yield rate, and the short-term bills, you will find that the 10-year G-Sec rates are actually now lower than the 91-day, are lower than the 364 treasury bill. So basically we are in a situation of an possible, this is too early to say, of a yield curve which is getting inverted, because short-term rates are now staying higher for longer. As you know, this liquidity impacts mostly at the short end of the curve, and long end is getting depressed because the inflation has been coming down. So this is basically a new asymmetric channel through which policy is getting transmitted. The overall impact has been that we are in a situation with a higher short-term rates and a lower long-term rates, and the gap between the two is narrowing down significantly if you look over the last, from March 2023 till February 24, which is the latest, of most of the latest number. Another important point is that, and this is extremely interesting, and this is actually future implications for research and this digitization, which Professor also said recently, is that there is also some structural changes in liquidity. Certain banks are now keeping excess funds with the RBI under there is a system called special discounted facility, where the banks keep the excess funds with the RBI and the RBI pays 6.2% to 5%. Look into this graph. We have done an analysis from 8 April 2022 on seeing when the liquidity was in deficit mode and the liquidity was in surplus mode. On if you look into the numbers on deficit liquidity base, banks were still putting around 60,000 crores of money with the RBI. So this is basically a paradoxical situation when we have a system liquidity deficit, but banks have money which they are keeping with the Reserve Bank of India. This actually has happened, and again there have been some areas of research in this context by the Bank of UK. is that they call it the unusable liquidity. Basically the liquidity which is mostly used for precautionary purposes, because today, for example, for a bank like us, if there is some specific demand, because now the NEFT and the NEFT transaction and the RTGS transaction happen 24 hours. So if on Saturday night somebody asks for some money, you have to keep that money with you. So this is basically another change in the liquidity which is happening. Banks have keeping liquidity for this precautionary purpose. In December 23, the Reserve Bank of India has actually allowed to decide reversal of liquidity facilities under both these accounts, even during weekends and holidays. So you can see that the availability of liquidity is also getting into online mode, given the facts that there has been a transfer of liquidity now mostly on a 24-hour basis. So there are many things which is happening on the liquidity, and perhaps in the future we can see the future direction of what in this area. Now, another important point, and this which is also going to change the discourse, is basically the financialization of the savings. What has been happening is that given this liquidity issue, which the government has decided to move into a just-in-time over a point of time, there has been also an exodus of funds from the bank CASA accounts. CASA is basically the current account and the saving deposits, which are the low-cost deposits. And also the fact that since deposit rates have remained higher for a longer period of time, the incremental deposit composition, which I have plotted on the right hand bottom, you can see that out of every 100 rupee of new deposits which is coming into the system, the share of CASA has declined to 30 in FY23 and that of term deposits to 87. So basically, in a situation whereby we have a liquidity deficit, through also because of reasons which I have cited, the share of CASA has been declining. If you look into the results of all the banks which have announced for December 23 and the others also, you'll find that the CASA share is increasing. And also the fact is that, and it's also sometimes is a myth that a lot of people saying that because of mutual funds is declining, it is not happening. Because what is happening to the mutual fund is that just an entry into the current account of the distributor of the mutual funds. So the important point is that with increasing adoption of alternate rate channels, banks may increasingly have to resort to non-deposit sources of cash of fresh deposit mobilization may trickle down. Today we don't have a problem. Outstanding deposits is around 200 trillion, credit is around 160 trillion. But at a future date, as savings of financialization increases pace and banks move to more non-deposit sources of funding, the deposit rates actually will act as a floor. I remember that earlier we had written about lending rates acting as a floor on the GSEC market, but on the deposit rates, increasingly the banks will find it difficult to reduce, and this may act as the current deposit rates may actually act as a floor. And you can see into the shares and debentures to household savings, which had peaked in 16-17, but that was an aberration because, as you know, that was a year of demonetization, but it has again started to go post-pandemic, but the share is still much lower than what developing other countries possess. So this is another change, but the financialization savings could change the discourse of deposits and systemic liquidity. Now, this is one more thing before I get into the other things. In the money, and this is also the RBI, in the money and the debt market, in the policy transmission, the liquidity in the money and debt market as India is not full. Money market is instantaneous and full, but GSEC market basically liquidity is concentrated in curves like 5 years, 7 years, 10 years, 14 years because they are more traded. So basically sometimes signals are conveyed across the curve in a disjointed manner. Corporate bond market also, which uses GSEC yields as benchmarks. Issuer lower rating depends on banks. So basically the transmission to corporates across the entire spectrum may be delayed. Finally is the commercial paper market segment where issuers are concentrating in maturities of up to 3 months with 95% of all issuance in the highest rating category. And CP rates, 40% of the resources are mobilized by CPs by non-banking financial companies which on-lend the funds after adding margins and premiums, thereby hindering monetary policy transmission. So transmission is not an easy thing. There are many contours of changes in transmission. It is sometimes complete in one segment of the money market, it is sometimes incomplete in the other segment of the money market, and this is basically an evolving situation in the Indian context. Now, let me talk a little bit about the policy communication and then financial stability. I think this policy communication, I'll in terms of research, I think over the last 2 decades, all central banks globally have moved towards clear communication and greater transparency. I think in the communication, I will show that our Reserve Bank of India has done a significantly better job than most other central banks. Bank of England, as you know, that has a history of guiding for interest rate hikes and rate not following up for action. But remember the George Soros incidents. Time and again, the Bank of England has also disappointed foreign exchange and money markets in an action which lead to loss of credibility. The Reserve Bank of Australia in early 21 stood by the markets as 0.1% target on 3-year bond yields. It then dropped the target and agreed rates might rise before the previously flat rate. Most importantly, if you look into the Fed, before 1994, the Fed didn't announce the Fed fund rate. Markets, however, like clear, transparent and emphatic guidance for central banks. I think this was one of the areas. In 1996, if you go back to 27 years, Alan Blinder had made a statement that by making itself more predictable to the markets, the central banks makes market reaction to more monetary policy more predictable to itself. In a seminar lecture in Jackson Hole in 2001 by Michael Woodford, he said that successful monetary policy is not so much a matter of effective control of overnight interest rates as of affecting the evolution of market expectations. And this is exactly what the central banks have been doing, and I'm sure that our Reserve Bank actually has done it quite commendably post the pandemic. This is basically, so we call it the forward guidance. So basically central banks are taking to communication before the policy action. This again is a lesson from experience that the market doesn't like unexpected news. Communication, instead of being a vehicle for policies, now the policy itself is a practice which was initiated by the Riksbank in the first instance. Most of the central banks like the ECB and the Fed were initially loath to the idea. For example, ECB, there was a former vice president we call Lucas Papadamos, who actually was believed that there should be more implicit guidance rather than explicit guidance. At that point of time, before 2008, the Fed chairman Bernanke, who was the first one to explicit that the Fed statement should be more explicit after the Lehman Brothers argument, he said that explicit forward guidance may be more useful to assuage market sentiments when uncertainty is high. The Fed started these issues. The Fed first started to give an forward guidance which he called the first generation policy signals of keeping rates low for an extended period. Then replaced the term by can be removed at a pace that is likely to be measured. The ECB also used words like strong vigilance. In August 2011, just after the crisis, the Fed moved to the second generation when it said that when it used that extended period to a terms like the rate could change unchanged at least till mid-2030. Simultaneously, to make its objective clear in January 2012, the FOMC released a statement on longer-run goals and monetary policy strategy, which he called the second generation signal. So we have moved significantly in this communication and the forward guidance as a matter of policy actions. What has happened in the Indian context? The RBI communication also has been swift and ambiguous, and here also there is a lot of literature. I will not spend too much time on this. The first is that from September 2010, RBI started mid-quarter reviews. Now they are mostly bi-monthly. Two times the monetary policy report are announced. There was now the need for off-cycle action has significantly declined. In recent times, RBI has also putting in a circular message of policy changes to its monthly and annual publication that sometimes escapes attention. I think if you go through the RBI documents on the minutes of the monetary policy, the MPC, and also some of the monthly and annual publication, you will find that some of these articles actually give some fair bit of idea what could be going on in the central bank's mind. The first thing is that when the pandemic hit India, the communication of RBI has been very clear that growth should get priority. The monetary policy had reiterated that whatever it takes to support the nascent recovery. This point, whatever it takes, has been used by the central bank governors, like I think this was at the time which was first initiated by Mario Draghi. This is the RBI policy statements during pandemic was all about forward guidance. What we are going to do in the future, both implicit and explicit. In April 2021, the Reserve Bank shifted, and I think all these are very important areas of research and how and communication can actually influence market expectation. First, the shift from time-based guidance to state-based guidance in April 2021. Timeless basically is a more explicit, state-based is more implicit. So for example, growth on a durable basis is not quantifiable but merely an implicit guidance on the state of the economy. Secondly, the explicit guidance was often guaranteed liquidity in the secondary market. I will show to you how this has happened. Thus, the RBI had adopted a liquidity strategy specific to the Indian context during the pandemic. The second thing was that the communication has become remarkably one-liners. Even the governor has said repeatedly that whatever it takes we should do in order to reinvigorate the economy. And there are communication, I think in 2022 there is a paper in the Jackson Hole that exactly this was said that the central bank communication states that such communication should be simple and constructively imprecise. This is what I am quoting from the Jackson Hole paper. Mostly it was published in 2022, where it done a research on whatever statements it takes if they're one-liner. So this is another area of communication which has changed significantly post the pandemic. I am giving an example over here. RBI governor has been constantly saying that the yield curve is a public good. If you remember that after the pandemic, the borrowings by the central and the state governments had crossed more than 20 trillion. So the idea was that the government, that none of us should be penalized in terms of higher yields. So what happened is that the first thing what happened is that the RBI governor, and this was the Bank of Japan was the first one to say this. The RBI said that the governor said that the yield curve is actually a public good.
Hello, Dr. Ghosh?
Yeah.
How long do you take?
5 minutes.
Yeah, it's shorter.
Yeah, so what happened is that before 2021, before these statements were made, if you look into the trading activities in the GSEC market, you will find that most of the activities actually were very significantly dispersed. After 21, here we have given a column over here. We can see that the activity of the banks were more in line with whatever the RBI has signaled. So the point which I am trying to make is that by saying this repeatedly that yield curve is a public good, the RBI was able to influence the market expectations in terms of trading in the Indian markets, so the yield curves actually followed the sentiment which the Reserve Bank was saying. I will quickly talk about policy coordination. I will take 5 minutes. I think there has been a lot of literature on this. Monetary policy coordination in Indian context has been largely missing. This is a graph for the last 30 years. You can see that there is a strong negative correlation between the M3 growth and the FD growth. However, such correlation is statistically insignificant across all measures, which I have not mentioned here. But during the pandemic, I think there was a lot of coordination between the RBI and the central bank. First was the government announced a package and an Atmanirbhar Bharat Abhiyan, just 10% of GDP. Mostly it was guarantees. The government also tries to increase the demand in the economy. RBI supposedly took a lot of measures like CRR, NSF, targeted liquidity intervention for several sectors, restructuring, changes in the NPA norms, deferment of interest. So all this actually was announced together, and which resulted in a lot of fiscal monetary policy coordination in the Indian pandemic. The Monetary Policy Committee has maintained the accommodation stance since June 2019, and it has however raised repo rates and changed to withdrawal accommodation. Finally, I think this is a paper I am not getting into. See, we have actually looked at this fiscal monetary policy coordination. We worked on results from an Conotan's Tackleberg model. The results actually were interesting, showing that the current repo rate at 6.5% is actually the ideal one. But the important point to note is that if you are moving towards a fiscal deficit target of 4.5%, with FRBN has said, the model showed that the fiscal deficit could in fact be higher than 4.5% in terms of the results. So the important point to note is that the government also itself has been tried on its path of fiscal consolidation in terms of moving towards a lower deficit. We had a deficit of 9.2% during the pandemic. We have moved to 5.8%, and our target is to move to the government target is to move to 4.5% later. Finally, a talk on this financial stability. I think this financial stability is an unresolved term. Even in the Fed Open Market Committee, nobody was sure what could be an effective lower bound reports. There have been statements by the Fed Governor Bhawan, but if you look at the examples of RBI, over the past few years, it has worked with the financial stability through a great success. This is the corporate bond spread which you can see, which was there before the pandemic, and now see the spreads actually at the lowest level. So there has been also a lot of success in terms of maintaining financial stability. This was unlike the crisis of the financial crisis years when there was some disruptions. Earlier also in the 1990s, I remember sometimes the bond rate has shot up, but this has not been the case recently because this has been worked with great success. I will talk a little bit about 1 minute about the CBDC. As all of you know, the CBDC is getting introduced. The financial stability could get a new boost with the introduction of the central bank digital currency. This could be offer an alternative lower risk option for risk adverse households. The most important thing of monetary policy in a CBDC era will be the impact on seigniorage, and the central banks could save up to 90% of the cost. The central banks could, I think there is not enough work on this CBDC because this is in a pilot stage. But if you look at some of the examples like the Bank of England research paper, this causes lower real rates, reduce monetary transaction cost, grow the economy and improve financial sector stability. I think this is one, we are working on one area of the CBDC. Hopefully that will give an idea about how it is going to impact. But I would like to end here by saying that the digitalization, which is not a part of this presentation, is that the digitalization has also impacted the money multiplier and other things significantly post-pandemic. And possibly the time has come maybe in the next 1 or 2 years, we could see that also as a measure in terms of the monetary aggregate which is going to get published. Which is published by the RBI on a continuous basis. I would like to end here and thank you for me the opportunity.
Thank you very much, Dr. Ghosh. I think your lecture is quite informative. How monetary policy changes through the transmission mechanism has impacted the economy in particular. Though the focus was less on the emerging issues, but the lecture was quite informative. Thank you very much. We are running short of the schedule. Now I request Dr. Tirthankar Patnaik to give his presentation.
Professor Kamaiah, Dr. Ghosh, people in the Econometric Society Conference, thank you for the opportunity. I will try to finish in 30 minutes. So the topic I want to talk about is retail investments. This is one of the things or issues, trends that has really come up since the pandemic. Indian markets, you all would have seen in Dr. Ghosh's presentation, one of the slides was on shares and debentures as a proportion of household savings. How it's come up, it's still shy of the demonetization numbers, but it's at about 4.5% of savings. So that gives you some sense of where my presentation is going to be. I'm going to talk about what has happened with retail investments in the last 5 years and basically quantify some of the numbers here and look at some of the behavioral aspects which because I'm part of the National Stock Exchange that has about 93-94% market share, gives us a unique position to provide some insights on. So here goes. Just a very quick thought on where we are as a market today. These are forward valuations of the Indian market on MSCI India and MSCI India compared with MSCI emerging markets. The core point on the left chart here is that India typically trades at a 16 times multiple to its forward earnings. So it is what one would call a very reasonably and richly valued market. And at this point, we are about one standard deviation away from that long-term average. Similarly, if I compare India versus the emerging markets base, notice that we are usually 50% more expensive than the emerging markets peers. So this is not for us as Indians who invest only in the Indian markets, but think of an Asian manager of funds or a global fund manager or a foreign portfolio investor. For him, India as a market is always 50% more expensive. This is on an average, and at some points, right now, in fact, it is 90% more expensive than an emerging market peer for India. India, therefore, is a favorable investment destination for both foreign investors as well as domestic investors. We know this, but I just wanted to provide some quantification of the numbers here. So, foreign institutional investors, for instance, in the last 25 years, they've been sellers of Indian equities only 3 or 4 times. That's it, significantly so. One was, as you can see in the chart, it was in the global financial crisis, and the other was very recently around the pandemic. Domestic institutional investors, the time series is slightly smaller, but shorter, but notice that in the last 3 years, their investments in the markets have also significantly moved up. And you can see the last 3 columns here. I'm not sure if you can see this part here. So in terms of numbers, they have put in about 2 lakh crores in FY22, 2.5 lakh crores in FY23 and so forth. So India is good from an institutional perspective, but I'm here to talk about retail investments. This is how the indirect channel works. We are still in the institutional investments territory. This is SIP. Everybody knows and hears about SIP. Everybody has probably heard about mutual fund Sahi Hai campaign, and this is the sort of impact. The left-hand side here is how SIP inflows have risen in the last several years. From a quarterly basis now, they touch about 45,000 crores. And what has that led to is that the DMF share, domestic mutual fund share of the Indian market has gone to about 17% of the free flow. This is again one of the implications of how successful SIPs have been. So I'm still talking about the indirect channel. Now I'm talking about the direct channel. So if you look at retail investments in India over the last several years, and we have 20 years data here that I will refer to again and again, but over the last 15 odd years as well, retail investments in India have touched about 19% of the free float in the market. And this is how retail investments have picked up. So, when I began looking at the markets in early 2000s, about 2% of the country were invested in the markets. And if you looked at from Dr. Ghosh's presentation there, the numbers prior to FY16, FY17 were about 1% or 1.5%. The average Indian household contributed about a percentage of its household savings to shares and debentures. That's it. And how many of us invested in the markets? Not many. Look at how many people directly invested in the markets, and these are not demat accounts but actual PANs, actual uniquely investors. In 2018, that number was about 27 million, 2.7 crores. Notice how the change has happened since then. 27 becomes 30, 37, and today it is 85. In fact, this is December 2023 data. Right now, we are very close to 9 crore unique investors of directly investing into the markets. This is not mutual funds. This is direct investment in the markets. And when they invest into the markets, do they actually invest every time? Do they invest every day? Not necessarily. So the right hand chart here shows how many people actually invested in that entire year. For instance, in FY23, about 2 crore people invested in the markets. So it's not necessary that when you invest in the markets, you have to invest every day. Not necessary. You can have a sip of a stock, you can buy a stock and wait for it. You don't have to necessarily trade. I'm trying to create a very clear distinction here between investors and traders. So, and the second column that I have here is of the derivatives market. So there also the numbers have picked up significantly. About 72 lakh people have traded in the derivatives market at least once in the in the current fiscal FY24. Now the point is, if the numbers have gone up so fast here in the left panel, where have they come from? India is of course a large country, and you will notice we've given here a region-wise distribution of where investors are there in India. So that number of about 8 plus crores comes largely from West India. It has been for a very long while, but the crucial point here is now North India. So again, India has over 680 districts. So where do new investors come from? One would typically think that the investor is your urban Indian, which is about 35% of the market. But today, districts beyond the top 100, they contribute nearly 40%, 45% of all the new additions. And again, in terms of regions, North India here is figuring up as a new place for investments. This was overall investors, this is new investors. And notice here that North India has contributed significantly. In fact, incrementally, it now contributes more investors into the markets than even Western India. And here again, the big state is Uttar Pradesh, which has its might in terms of population, but which is kind of showing up now in the market entry as well. I will now go to flows. I will spend some time. I'll come back to this particular part when I talk about districts. But in terms of flows, I've just shown something very interesting in terms of net flows. So we follow a fiscal year, and what we've done is every year's cumulative flows from the markets into the markets rather are put in from an April to March chart. So we begin at 0 every year, and as the year flows, we either are negative into the markets or positive into the markets. You will notice that barring the last 3 years, retail investors have been generally sellers in the market. So our typical construction of the noise investor who doesn't know much in the markets, who comes, basically loses money, and therefore the idea is also to look at probably indirect channels of investing into the markets. Again, the mutual funds are here. That seems to have had some second thoughts in the last 3 years. Look at our charts here. So seemingly numbers have started picking up from the direct channel as well. And this is again coming back to some of the points Dr. Ghosh also made. So one, of course, is what has been leading to this kind of investments. Of course, lower interest rates, households are moving away from fixed income based investments or instruments of savings, and they are moving towards shares and debentures. And in the pandemic, one saw a sharp jump in savings, which has subsequently come off, but numbers did pick up. So we have two thoughts here. Why exactly did these retail investments happen? One of the many causes beyond the interest rate arbitrage or a better return for their assets has been the digital channel. So one of the things Professor Kamaiah also spoke about was this issue of digitization. So here digitization is seen from a positive perspective. India has created DPI. The term is DPI, Digital Public Infrastructure, at better than probably any country in the world. So Indians today use more data than any country in the world, not just in toto, but also on a per capita basis. The average Indian uses more data than the average American. The average Indian uses more data than the average Chinese. And of course we use it largely for YouTube, but yeah, I mean, this is what it is. So the fact is we have a channel today which allows us through initially it used to be JAM. It allows us to invest in any kind of instruments rather seamlessly. I keep saying when I kind of talk about this topic that in a class, if you're feeling bored enough in my lecture, you can open a stock market account. It takes only that long. You can do it from your phone. So, but I'm taking a bigger picture here. I'm looking at overall ownership in the markets, and notice there are two trends that I've been speaking about. One is how retail investments are picked up directly, and second, how retail investments are picked up from an indirect channel. So in this set of pie charts, I'm not sure if you can see the numbers here, but let me say this. In September 2006, domestic mutual funds had 4% of the market. 4% of the market. That number by 2013 had dropped, in fact, to 3.3% of the market. In absolute terms, it could be higher, but in percentage terms, it had dropped. And today, that number is 8.7%. So in the last 10 years, the share of domestic mutual funds in the market has doubled. This is the big saving shift that is happening into shares and debentures, again from an indirect perspective. One other point that's to be very important here is, so I used to be in an investment bank many years earlier, and our major clients were all foreign portfolio investors. Today, not so. Our major clients, for an investment bank today would be domestic institutional investors. In fact, if you add up the non-promoter Indian ownership of the Indian market versus the non-promoter foreign ownership, the non-promoter Indian ownership is today higher, which effectively means that if you have global tidings of rising interest rates, dropping interest rates, in the face of such headwinds, the Indian markets today are much more resilient than their emerging market counterparts. I will show this at some point in terms of numbers. In fact, right here. So what we have here is a research, what's called a return quilt. This is the return chart for a global investor. He could be investing in Bitcoin, Nasdaq, in the Russell 100, Russell 1000, MSCI World, and so forth. And what I would like to point out here is, look at the second last column, and you will notice that 2022, the year of the Russia-Ukraine war, the year of the Fed moving away from transitory in their inflation forecast. The year of high interest rate hikes led to a significant bear market for risk assets, absolutely global equities as well. So MSCI World fell down about 17%, Nasdaq was down 32%, Bitcoin was down 64%. In fact, gold was also flat. But in that year, where, by the way, incidentally, FII sold the most in this particular year, Indian markets actually went up 6%, 5.7%. So that is the consequence of some of the points that I made earlier, that retail investments, either directly or indirectly in the markets, are such that Indian markets are, that's translating into higher resilience for the markets. I will now focus a little bit on the behavioral aspects of this investment. What exactly is happening? Where are they investing? Are they taking more risks? We learn in our finance classes or market microstructure classes that retail investors are noise traders, of course, right? So let's see that. Now, first of all, what we've done here is we've taken the gross traded value of all the stocks traded in the market and put them into deciles. So the higher the decile, the bigger is the market cap, and it's obvious that the bigger stocks trade the higher. So in terms of understanding this table, look at the first column, the very first number, 10th decile, has got 49.5. What it means is the top 10% of stocks in the market, which will be your Nifty 50 and Nifty next 50, top 100 stocks, they accounted for about 50% of the entire turnover in the market. So they were only 10% of the market in terms of numbers, but they accounted for 50% of all the turnover. Now what happens is, when risk rises in the system, people move away from small cap stocks to large cap stocks. They seek shelter in large cap stocks, and when there is a risk love scenario, when people are willing to take risks, then trading starts shifting from the large caps towards small and mid caps. And some of us who follow the market, you will notice that happening in the third quarter of last year, fourth quarter of last year, small and mid caps. In fact, last year the Nifty did 20%. The overall market cap of India went from touched about $4 trillion, so went up about 29%. But small and mid cap universe did 45 to 50%. So this is the time when people wanted to invest in smaller caps. And notice what has happened. I am not talking about such periods. I am talking about this periods here. So typically, when people were looking at risk, the share of the higher decile became even higher. What exactly are retail investors buying? I am trying to answer those questions now. So, of the NSE listed universe, the entire universe, which has about 2,500 stocks, retail today owns about 9.4% of the market. Yeah. Compare that with promoters, they own 50%. Foreign institutional investors, they own about 19% of the market. Now, if I look at the Nifty 50, which is the top 50 companies, these contribute about 55-60% of the overall market cap, understandably so. The share of foreign institutional investors is even higher. They own about 25% of this market. And retailers own less, relatively speaking, from 9.4 to about 8.2. But if I look at all listed companies X the Nifty 500, in other words, take the 2,500 companies, take away the first 500 companies, you're left with a very, very long tail of small companies. That's where retail investment is 20%. So the average retailer is taking more risk in terms of the smaller, small and mid cap stocks. This is something very interesting that we see. And if I look at the free float, that number is even higher. The average retailer today owns about half of the long tail in Indian markets. Now, who trades in the Indian markets? Why do we consider retail investors important? So I've told you that they own about 9% of the market. That part is right. But market is not about just owning shares, it's also about trading shares. So you notice that the big yellow column here is retail investors. So retail investors today trade more and have been trading more than foreign investors, than domestic institutional investors. From a trading perspective, retail investors are very, very big in the market. And in years like this, FY21, FY22, these were the pandemic years, their share of trading actually goes up even further. This is one of the points that I wanted to make. And in derivatives, not so much. Derivatives, their share is less because prop traders, principal traders, they trade more. This is a far more technically driven market, and therefore it's not so much. But for cash markets, retail investors are the biggest share, and the point I'm trying to make here is this is why they are very, very important. Again, region-wise, where exactly are retail investors trading? The only takeaway here is North India. The share of North India is rising over the last several years. This is 20 years. And where do these new investors come from? So where do they trade? Mumbai counts for the biggest chunk, and then Delhi, then Ahmedabad, and then Surat, Kolkata, Jaipur, Hyderabad. But this is not as interesting as this. New investors, where are they coming from? So you might have guessed Delhi is one area, Delhi NCR. NCR has a region which is part of UP as well. Delhi, Mumbai, but importantly you see North 24 Parganas. You see Bardhaman. So these are districts where new investors are sort of coming from now, which is again very interesting. Again, for us, I mentioned that the districts below the top 100 contribute to about 46% of the overall new investors. I now want to talk about a little bit about the distribution of these retail investors. This being an econometric constant protocol, let me look at some of these numbers and notice the Gini. The Gini in the retail investors, all 8 crores of them, is very, very high. So if you look at 1 as complete inequality, you will notice that the Gini is about 9.2 or 92% rather in 2010, and in 2021 that number has actually gone higher. So while retail investors are one big pool of nice traders, they not really are. In fact, the top 10% of retail investors contribute to nearly 90% of the overall turnover in the markets. And the same goes for net investments as well. So retail investors are a very, very, very skewed distribution, highly skewed distribution. And in terms of numbers, because this is just the Gini, in terms of numbers, notice this, the last columns here. In November, for instance, 1 crore people traded. Out of those 1 crore people, 35 lakh people traded for less than 10,000 rupees in the entire month. And this is about their overall turnover. If I go up to say 1 lakh, my number will go to 35 lakhs plus 39 lakhs. So about 70 lakh people, more than 70 lakh people out of the 1 crore traded less than 1 lakh number. And if you see the big guys, 16,000 people, 16,000 investors traded more than 10 crores in the entire market. This is trading, this is not net investment, and they contribute about 20 basis points of the trade. So the point here is to give you an idea about just how skewed the market is. And notice this 16,000 has your mutual funds, it has your foreign institutional investors and everybody, but the tail is very, 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 very long. And in derivatives, it's actually even higher. And I just wanted to show a couple of points here. So I have 10 minutes or 5 minutes? Okay, thank you. So we did a quick analysis of, when they come into the market, do they stay in the market? So if you notice here from 2020, what we've done is we've taken a cohort of investors that traded in a particular quarter and we wanted to check if they stay in the next quarter. So you will notice that, for instance, 58 lakh people traded in the first quarter of 2020, but the next quarter there's a significant drop. Again, in the next quarter, 62 lakh people traded, but of this cohort, very few traded, relatively fewer traded in the next quarter. So, and this keeps going on all the way till 2022. What I'm trying to say here is the market is very interesting. More and more people come into the markets every quarter, but they don't necessarily stay in the markets. This still does not negate the thesis that more people come into markets. So you have a very curious and very interesting aspect of Indian markets where markets are relatively getting incrementally more interesting. Households, I will come back to that point, households are allocating a higher share of their savings into non-fixed income based instruments, but when they touch the market, they don't necessarily stay in the market. So there is buyer's remorse as well. So this number went up all the way till 1.6 crores, 16 million in 2022, and notice what happens every next quarter. So a big chunk does not trade in the next quarter. And my last point in the presentation here, we all look at standard demand supply curves. This is everything that we have seen in Economics 101. We have an equilibrium point, we have supply, demand, and so forth. The point I'm trying to make here are twofold. One, investors in the market, they face demand and supply as well. It is a market after all, and they also face trading costs. You know, a perfect competition does not look at trading costs here. I wanted to sort of quantify what kind of trading costs investors face and what kind of demand curves do they essentially face. So notice this chart. I will keep coming to this chart again and again. Look at this here. So you can see a lot of numbers here, but I will just, please have some patience here. This is Reliance on November 30th, 2022. So at 9:15, we have the market. There are 518 people, 518 orders that we are having in the market. People are willing to buy Reliance at 27.12, and people are willing to sell Reliance at 27.12, 50 paise. So this is the gap between your supply and demand. And this is something that we will try and quantify in terms of the demand supply curves that I pointed out earlier. Notice the demand supply curves, they intersect, and the point of intersection is the equilibrium point, and on the x-axis is Q and the y-axis is P. So if I try and chart this in terms of demand and supply, this is what I get. This is my supply curve. The blue part is my supply curve, and the red part is my demand curve. So you will notice that the demand and supply curve try and intersect at this point, somewhere here. This is where the equilibrium point will happen. And beyond that, we never see the left part of the demand and supply curve, as you will notice, for obvious reasons, because at this point, the equilibrium will already have taken place. You will never see a place where demand is at price P here and supply is here. I mean, naturally, there will be automatically, people will be willing to buy. It's like you're offering something at 90 rupees and people are willing to buy it at 150. That will be an instantaneous trade. So what in real life we get is this part of the right hand side of our supply demand curve. This is the demand supply curve and this is the demand curve. And notice this is only at 9:15. The demand curve shifts. So this is how the market looks at 11:15 for the same stock. This is at 9:15, this is at 11:15, and notice this happens at every point in time. To simplify things, this is how demand and supply curves will look at different points in time. At NSE, we have this at every microsecond, but for simplicity, I've just shown it at 9:15, 11:15, 1:15 and 3:15. So this is how demand and supply curves keep shifting during the day from our perspective, and that's where the equilibrium points keep happening. And now the last part of my presentation, I spoke about the demand and supply curves that investors face, and now I'm talking about costs. Markets are not costless, markets are not frictionless. So investors face two types of costs. They have direct costs and they have indirect costs. And again, one of the issues that I come back to Professor Kamaiah's point. One was on digitalization, the other was on these costs that investors would typically face. This is again one of the issues. So when you trade often into the markets, you do face these costs again and again. Now there are direct costs which you can quantify very easily, and there are indirect costs that you don't really. So in terms of, I'm going to talk about not the direct costs which everyone can do, but I'm going to talk about the indirect costs which you will face when trading in this particular scenario. So very quickly here, I'm sure the numbers are visible. You trade you give a trade of 1 lakh, very simply. You will face a total cost of what? 415 rupees. That's it. So you have brokerages, you have exchange fees, you have SEBI fees, you have GST, you have so many other things. So for instance, the biggest, out of the overall cost of 415, your charges and taxes are about 355 rupees. The rest is impact cost. Impact cost is what you will pay over and above your buying price and what you will get below your selling price. You wanted to buy something at 100 rupees in the market, you will not get it at 100 rupees. You might get it at 100.05. 5 paise may not seem much to you. At a 1 lakh rupees, it is basically just 60 rupees trade. Most of us will not even notice it. And I'm going to try and quantify this a little bit here. And this is what happens when you trade often. And I just wanted to quantify some of the trade costs that investors face. So I mentioned this already. Impact cost is what you pay over and above your buying price and what you get below. And it will be very clear. Impact cost is asymmetric across buy and sell. Notice this here. The buy and sell curves they don't have the same slope, they don't have the same demand, they don't have the same prices either. So you will see asymmetry between buy and sell depending on what side of the market. Again, in a very liquid market, you may not notice this, but when you trade often, these things will come into the picture. And this is how impact cost looks like. Yeah, there is nothing here. So what I have shown here is some of the big stocks in the market, and you wanted to trade, and I have basically just quantified impact cost. It seems like zero. And if I graph 60 on a base of 1 lakh, nothing is visible. So this is what the investor sees, and he is happy. What I have done here is we have given orders from 1 lakh all the way till 20 lakhs. Still in retail territory, but this is what the investor sees. However, if I magnify this chart, life is like this. It is not quite flat. This is what the investor sees. This is that 60 rupees. But if you magnify this, you get this. So impact costs vary a lot during the market, and investors, as they come, and they trade again and again in the market, they face these impact costs. And you will notice here that impact costs change through the day depending on the liquidity available. They are also asymmetric. Sometimes on the buy side there is high liquidity, sometimes there is on the sell side high liquidity. Depending on which side of the market you are, you might face significant levels of impact costs. And by the way, these impact costs will change by the liquidity of the stock as well. So for simplicity, what we have done is, and the various lines that you see here are orders from 1 lakh to 20 lakh. On an average, very simple, average on buy and sell impact costs are different. I already mentioned this. For a stock like SBI, you won't see probably any impact cost. It's flat. When you want to buy it at a particular price P, you will get it at P plus delta, and delta tends to zero, very less. But if you go to a low liquidity stock, you might get significant levels of impact costs. And notice my earlier point made that retail investors do buy the long tail. Retail investors are 49% owners in the long tail of the market. This is something that they need to be cautious about. And this is how it is over through the day. SBI, for instance, and then you get lower and lower liquidity, the impact costs keep rising. At some point, you get significant levels of impact costs. So I just wanted to stop here. I wanted to point out that we've spoken about how retail investments have picked up in the pandemic, and how retail investors today are a significant and important part of the market. They trade the most in Indian markets today. And what do they buy? We noticed that while they buy through the indirect channel mutual funds, which has translated into mutual funds owning double their share of the market today as they were even 5 years back or 10 years back. They do invest through the retail direct channel as well, and their number has gone to about 8 crores now, or rather 9 crores as we speak. And they do buy the tail of the market. And I wanted to point out two parts. The markets are not frictionless. We know this, but we try to quantify this. And I just showed how they face varying demand and supply curves through the day, and of course the cost that they face. Thank you.
I think all of you agree with me that we had two inspiring and informative lectures. Dr. Ghosh presented how monetary transmission mechanisms could influence the money market and the financial markets in general. He has presented enough data to convince us that monetary transmission mechanism is quite important in initiating change. Thank you, Dr. Ghosh. Then Dr. Tirthankar Patnaik has presented the growth and composition of retail investment. He highlighted how retail investors are important in the stock market, and some of the issues he diagnosed, and with the help of adequate data he presented the issues. In normal course of time we would have taken some questions. Now that we are running short of the time schedule, I regret that we are not able to take any questions. I think with these few remarks, thanking both Dr. Ghosh and Dr. Patnaik, I conclude this session. Thank you.
Thank you very much, sir, for your very nice summary. Sorry, because of organizational preoccupation, I could not attend the whole session. Although I was here and there, I was listening. I'm thankful to Dr. Ghosh from SBI, who has been into various assignments. All of us know that when he was introduced, we were told the kind of assignment that he is preoccupied with. With all kind of busy schedule, he could make out, he could come, he could share the time. He was here with us, and he will be here for some time. Those scholars, I'm sure parallelly there is some technical session going on. Some of the scholars who are sitting here are running to the parallel technical session. So I'm sorry that we are not able to discuss much. All those scholars who would like to get in touch with absolutely practical policy making, please contact both Dr. Ghosh and Dr. Patnaik. Dr. Ghosh, thank you very much for coming here. And special thanks because SBI has been a very important pillar from almost for 20 years in pushing the organizational and academic cause of the Indian Econometric Society. And you have taken initiative, you have come here, and the Indian Econometric Society is thankful to you. Dr. Patnaik, I know you very well, and very good lecture. Sorry I could not hear Dr. Ghosh, but I have heard you. I know I have earlier also I have heard you, and very good thought-provoking lecture. In fact, this kind of lectures should take place at institutional level, also at universities and all. And I will be looking forward. And you have been now the part of our organizational network, and I'm sure you will be able to push in your own way the academic cause of the society that we will be pushing in time to come. You have taken your own time and you have spared your time, and thank you very much for coming here and giving your special ideas. Thank you very much. I thank both of you. I thank Chair.